Well, I'm back. So I've said the major reason why inflation accounting or the accounting for the price level changes is a hot topic in the financial accounting literature is because of the deficiencies that you've had with the historical cost. And the historical cost approach, of course, it assumes or it rides on the past data. And therefore, in the economics of accounts or in the most of the economics in the world, they are characterized with the environments of what we call the non-stable prices. And that is what we call inflation. Sometimes the prices goes up, sometimes the prices goes down. But in many occasions, the prices goes up. So under such circumstances, it is highly unlikely that the historical cost approach is able to satisfy the informational demands of users who's now depends on these estimates or these financial data to make their investment decision. So we normally say that the historical cost approach is well established and it is a generally accepted accounting principle all over the world. Reason being, in the financial reporting, it is able now to fulfill most of the stewardship function assigned to the financial report. And we know that financial report is supposed to give us the true and fair view. And in the true and fair view manner, we now consider our historical cost or the cost that we incurred as the true and fair. So the historical cost approach has been able to provide information, albeit limited. Note that word. So it's an approach that we've continued to rely on in making decisions or presenting information about the firms or the businesses that we are reporting on. But if there are any changes in the pricing, now the information that we are going to report will be misleading because it will not be true and fair view. So in most occasions, or in the following occasions, we may see the historical cost approach failing. The first one is where the balance sheet figures for assets are based on the cost at the time of acquisition. And they are unlikely to reflect present day values because they lack what we call additivity. And this is when you are talking of the balance sheet, including now the conglomerate of the cost incurred on different dates, it will not enable the users to realistically predict future cash flows related to those assets. And I'm saying this because you realize when you are doing the balance sheet or the statement of the financial position, we normally have the column for the on cost when we acquired them. Then depending on the depreciation method, we have now the depreciation column, and then we have the net book value. So it is highly unlikely that whatever we'll be reporting at the end of the period is not realistic because we defined our approach at the start of the period. So you can imagine a situation where an asset, let's say plant, property and equipment have been used in the company for a duration of, let's say, 10 years, some 15 years. Some will even run to 30 years. It's only that they do some maintenance and repair works. So you can imagine an asset that we acquired, we are in 2020, we are talking of an asset that was acquired by a firm in 1990. You cannot, even if you look at the value of the shilling in the market, we expect that we are going to definitely have some differences. Secondly, if the profit or the income is dependent on the measure of the capital at different dates, if it is really on the measure of capital at different dates, then the profit measurements can be considered to be the result of comparing two fairly meaningless totals. And when I talk of two fairly meaningless totals, I mean our profits results will always be overstated. If anything, or if we are basing our analysis on any ratios, let's say on the return on capital employed, it means that even the ratios will be overstated. Now, overstating this information leads to what we call violating the prudence concept. Because prudence concept has it that we are not supposed to overstate, nor are we supposed to understate the figures in our books of accounts. Thirdly, historical cost profit give a misleading impression of ability of a company to continue to operate at the same level. In other words, we are saying that this company is not growing. So we are retaining what we call the status quo. And by status quo, now we'll be going against what we call now the going concern. Because going concern assumes that this business will continue being profitable, it will continue expanding to an unforeseeable future. And lastly, a series of historical cost account will give misleading impression of the financial trend of a company. I've just given a case where an asset has been retained, a non-current asset has been retained in the company for a period of 30 years. By the time we'll be doing the financials, as at the end of the 30th year, you can bet that it will be totally misleading. So that's why we are bringing in the aspect of the pricing, and our approach will be guided by some few models that have been brought forth by analysts, of course with some academic argument here and there to see whether they'll validate their case. Now, we have the capital maintenance, which is the first case scenario or point of argument. And in this one, we are saying that there is always a relationship between profit and capital. Now, conventionally speaking, if we go the traditional way, we know that profit is calculated by setting the expenses against the revenue. So I had my sales for this period, let's say 1 million. I incurred expenses of 300,000. Automatically, I can tell that my profit is 1 million minus 300,000, which gives me 700,000. So we are saying that traditionally, profit is net of, or it is now the revenue we less the expenses. And in a formal statement, this is what we call now the profit and loss account. We just get our profit or the sales revenue, we net off all the overheads or all the direct and indirect expenses, and there we are. Now, the alternative view of the profit is to see it in absence of fresh capital input or drawings. So when we are looking into, let's say, a company that we are injecting zero capital, so we are still retaining the capital that we had initially, and there are no drawings, then we net off our operational cost. Whatever remains now will be the net worth of the business. And this is the case that I've tried to illustrate here. So you can see the formula, this formula, I is equal to D plus in bracket K2 minus K1, where our I is now the income for the period. We got the dividends that are distributable. We are assuming that this company is generating profit or dividends to its shareholders or the shareholders of the equity. And then we have the capital as at the end of the period, and we subtract now the capital as at the beginning of the period. And we know that traditionally we'll be doing now the statement of the change of equity, assuming that there is growth every other financial period. So if that is the case, now we are assuming a scenario if our capital as at the end of the period is greater than the capital as at the start, then we expect that our income will be equal to the distributable dividends. Now, the other case will be when we are assuming that our capital at the end of the period is greater than our initial capital. So in the first case, we are assuming status quo to mean whatever we injected still stays. So we are assuming all factors held constant. No additional capital, no drawings. So our K2 is equal to K1. That will give us 0. So our income will be equal to the distributable dividends. If at all our K2 or the capital at the end of the period has increased, then we also expect that our income will be greater than the dividends that will be distributable. But if it is on the converse, where our capital has reduced, let's say there are drawings, or some of the shareholders withdrew their equity, then we do expect that our dividends, distributable dividend, will always be less than the income that you are purport. And if anything, then we'll be eating into the reserves to ensure that we distribute such dividends. So in other words, we are saying that for the capital maintenance, we are trying to say, or we can see, that capital, we are able now to argue out and say, as it can be seen in the equation, income is recognized after the capital at the beginning of the year is maintained at the end of the year. Without doing that, then we don't have and that's why we are calling it the capital maintenance model. So we are saying that the minimum concept here is retaining the original capital. And our capital, we know that it represents the absolute minimum funding that the owners will want to be retained to the business as a form of security for now the creditors. And to keep the business at least at the, what we call at the level of activity, then our original capital is not supposed to be altered. Are we there? So in order to keep track of the essential capital, accountants it's been a tradition to ensure that the capital and the original capital and the revenue funds are put into consideration. That's why I'm winding up by saying here, the value of income depends on the manner in which the capital is measured. So if we maintain our original capital and it becomes our base, then we really need to have some various models that will help us now measure or trace our income. And we have two broad categories. We have what we call the economic income model, and we have the accounting models, and they are several, but we are going to cover what is important. Let's start with the economic income model. And I'm trying to summarize this in a manner that everyone will understand. So it's like the former formula, only that our dividends now have been captured here as realized cash flow for the period. So we are replacing our dividends or the distributable income with realized cash flow. So the equation is based on Hicks' model of ideal income, and he defines income as being the amount a man can spend and still be as well off at the end of the period as he was at the beginning. That's the rationale. So the approach, or this approach of measurement of income, it is sidestep all the problems associated with the year-end adjustments of profit. So we are assuming that whatever we started with will still be there as at the end of the period. So the estimations of accrual and prepayments and the assumptions about the fixed asset lives, etc., all the manner of adjustments that we embody when we are doing now the statement of income and expenditure are entirely avoided. We are avoiding that. Now, we know that there is a main disadvantage into this, or if we avoid, because you are going to misrepresent facts. So the main disadvantage will be probably that when we are calculating the well-offness of our capital or the well-offness of the company, we are going to subject now this to the estimates. And therefore, our professional judgments, if you remember the value of capital at the beginning and at the end of the period, should be defined as a discounted present value of the future income stream, right? When you are doing now the NPVs to help us now judge and to know whether the business will continue being a going concern, we really need to discount now the present value into the future income streams, right? And this income is measured from changes in capital. That's why we normally adjust the statement of equity every year. And this is because we are bound by the accruals concept, where capital is the residual after measuring the income. But the economic income model negates all this. So our future cash flows are discounted at the entity's cost of capital. And the maximum that we can spend is what now we call the well-offness. So when we are looking at the income and we are looking at the cash flows, this becomes an essential feature of this model. And the definition of income, if you recall, we say that the definition of income is consumption and the savings or the de-savings. It's either you are consuming or you are saving or you are not saving. So the sums, all this is what give us now the value of income. So the sum saved should be reinvested and earn some interest. And that's how we are able now to discount for the future cash flows at present. If that is not done, then that model will not work economically. Are we there? Tuko pamoja. I don't want to lose anyone. Tuko chonjo. Fiona, how are you? Fiona doesn't have a mic. Felix, you're good? Ogola. This Felix Ogola. Uko salama?
I'm good.
Fiona, you are good?
Yes.
Fiona? I don't know what is happening to Fiona. You are
Yes,
good,
I'm
Fiona?
good.
Ah,
Yes,
wonderful.
I'm good.
Fantastic. You know, this was abrupt. Maybe you are, najua Monday iko na maneno mingi. I didn't want to interrupt your Monday. But what I've stated is, if we don't have any complaint, our class still stays at Tuesday in the morning. Ni sawa? It's only that tomorrow I have another important business to attend to. I had explained to Dennis. So we can go on. That is the economic income model. Now we have the accounting models, and I've said they are several, but I want us to just cover a few. And these models, they normally they classify themselves into three. We have the classical, or we have the classical school, we have the neoclassical, and we have the modern. And when we are talking of the classical, this is merely the historical cost accounting, where the capital is maintained by the money terms. If I purchased a plant at 10 million, that remains its historical cost in the source documents. So any other entry that I'll be doing, albeit depreciation or the depreciation method, I'll consider this as my cost. So if we have a historical cost, let's say of 1,000 as at the beginning of the year, and at the end of the year, assuming no distribution and no injection or withdrawals, we expect that we are going to have that 1,000 retained. So any figure over and above the 1,000 or over and above the historical cost becomes now our income. It is so traditional, no adjustments. In the neoclassical, not old, not new, it includes historical cost accounting, but accept now the adjusted changes. And this is what now we call the general purchasing power. and it makes sure that the purchasing power, when you are, if you recall, when you are doing now the accounting for the foreign currency transactions, we were involving some rationale where we could argue, depending on the prevailing situations, we could accept either to go with the exchange rate at the domicile company's end or at the holding company's end. That is neoclassical. And then we have the modern school, where we do now the current value accounting. We have a lot of opposers in this model than any other. Now, this model tries to maintain the operating capability of the entity on what we call now the going concern concept. We are assuming that our business is a going concern. So the operating capability of the business entity is to replace the assets that are worn out, consumed, and we get other ones that are more effective. Because our concern here is to produce more and ensure that we maximize the profits on the shareholders. Are we there? Now, in this category, I want us to look at the inflation, because this is the real argument that the value of the shilling, for instance, if we are there in 1980s, don't know whether, let me even give 1990s, the value of the bread, now the size of the bread have actually shrunk. Bread used to be so huge, it used to be 600 grams. Yeah, that was the standard size of the bread. But of course, the taxman has tried to juggle our mind with reducing the size, but the prices have still gone up. So assuming we are still arguing on the 600 size, on the 600 gram size of the bread, it used to trade at 8 shillings back then. Right now, at 600 grams, the prevailing market rate will be from 70 to 100,000, depending on the retailing outlet, isn't it? So the size of the bread is still the same. The people who are eating are still the same, only that the value of the shilling has fluctuated, and this is what we are calling inflation. So the loss of value really affects now our reporting. And the historical cost approach does not reflect the impact of the changing prices on the net assets and the earning of the company. But there is no agreement that has been reached to date that will provide information to the users that are fair and true. That is why HCA has been retained. However, we have two approaches that tries now to explain this. The two main approaches are inflation accounting we have the current purchasing power, and we got what we call the current value system. And I want us to start with the current purchasing power accounting. And this accounting requires, or we also call it, the other name of the current purchasing power, you'll see some other authors calling it the general price level. Actually, the prevailing price. So we are talking of the general price level approach. That's the current purchasing power. And it requires that the historical cost be based on the amounts that can be translated to the current purchasing power, equivalent using the general price level index. So we are saying that the current purchasing power attempts now to maintain the shareholders' capital in terms of general consumer purchasing power at current. And that's why we are calling it the proprietorship concept of capital maintenance. Now, according to this approach, all the items in the profit and loss account will be expressed in terms of the current year end, because that will be the prevailing purchasing power. While the same will be true in our statement of financial position or the balance sheet. So thus, all the items in the statement of the financial position will have to be converted in terms of the year-end purchasing power. So we are trying now to avoid the historical cost approach by bringing the aspect of the prevailing market price or the general price level, except for what we call the monetary items. And these are now the assets and the liabilities. So you see, we are trying very hard not to compromise the historical cost approach, but we are trying to express now the non-monetary items into present. Now, we can only have an illustration to see what or how it pans out. We have this illustration. I had shared the illustration in the portal so that, or to allow me to navigate other windows. So I may leave this page and try to work from the, are you able to go to your portal? Good people. Can you go to your portal and get this illustration? It is in the portal. I'll keep on leaving here to the, see on my end, I'll have the advantage of multi-screening, but on your end, you will be inconvenienced. I'm waiting for a response from your end. Can you quickly upload download the illustration? The one document, the one page, I think 2 pager. Can we do that, guys? Suhura, how are you? Hassan. Hassan, you are good?
I'm good.
The last time I checked, you are on medication. You are good now?
Yes.
Fantastic. Are you able to download the illustration?
I'll try.
You'll try, Zuhura. I want you to do it right now. I want to leave that. I want to stop sharing the screen.
Okay.
We work from whiteboard.
Okay.
The other people, are you able? Have you downloaded?
Yes.
So have it on the side because I want us to work from. So I can just open an Excel sheet. We work from an Excel sheet and see how these prices are being adjusted. So I'll stop sharing this. I will allow me to delete this. This was for former class, or instead of deleting, I can just open another sheet. I might need it. You can just insert another workbook. We work from a different sheet. So we are where? So we've been given information there. And we are looking into the CPP, or the general price level approach. And you said that on the monetary items, those are assets and liabilities, we retain the historical cost, but on the non-monetary items, they'll change. And that's why we are calling it the proprietorship concept of capital maintenance. So if you look at Nyumba Limited, it engages in real estate business, and currently they are owning only one property, and their main form of income is rental. And this is deliberate. I'm trying to simplify this for our understanding. So we have the balance sheet portrayed there. So you can see the building. In year 1, The building is valued at 150. In year 2, 105. Of course, because of depreciation, we know that it loses value. It's an asset. So we have the comparative income statement for the 2 years. Revenue for year 1 was 82,500. Year 2, 90,755. Depreciation has been constant, 45, and we have our net income. We've been given some additional information that the company was formed on January 1st, so the year is ending on 31st December. The building was acquired on January 1, and the cost of the historical cost is 195,000, and the expected useful life is 4.5 years. That is the useful or estimated useful life of the building. We are going to use the straight line method. The on cost will less the salvage value. So we'll be expecting at the end of the 4.5 years, we are going to have the scrap value because it's not given over the estimated useful life. So all revenue is received at the end of the year to mean we are not adjusting. I'm trying to play safe. There are no operating expenses except depreciation. All the net income is paid out of dividend, is paid as dividend, and the balance of cash banked at no interest return. So whatever remains is banked as cash at bank. Then we've been given the price indices for year 1 and year 2. 1st January, it was 100 shillings. Year 2, it was 105. So we are seeing inflation. And as at the end of the year 2, it's again inflated by 5 shillings. And we are required to present the statement of financial position and the income statement for Nyumba Limited for the 2 years they've been in business. Yeah. So you can start with the income statement. Now this one is simple. You can just merge this. Income statement. As at the end of the period, you've not been given the period. So as at 31st December. So that is that. You can have the column here for revenue items. And you can have year 1. Just make it simple. Year 1. And we have year 2. So what's the revenue? You'll be given the revenue figures. So the revenue is year 1 is 82,500.
Yes.
Year 2 you've been given is 90,755. Right? So we've been told that the only cost is depreciation. That is the only operating expense. So can we account for depreciation? We are using straight line method. So as at the 1st of January, we've been told that, maybe I can work on the side here and call it working 1. So we've been told on 1st January, so this is 0101. No, 0101. So on 1st January, we are told that it was 100 and the cost was 195, isn't it? So as at the end of the year 1, so 31st December, we have an inflation of 5 shillings. So what will this give us? The question mark. Can just cross multiply, isn't it? So this will give us 105 over 100 multiplied by 195. What are you getting? If 100 is giving us 195,000, then 105 should give us 105 over 100 multiplied by 195. What are you getting?
204,750.
204,750. So 204,750, but that is not the depreciation. We are looking for depreciation, isn't it? So 204,750. So you are supposed to divide by 4 and a third. You can just make that to be an improper fraction. 4 and a third is 13 over 3. So multiply 204,750 by the reciprocal of that. So multiply by 3 over 12 over 13. What do you get? Want to get the figure for depreciation?
$47,250.
47,250.
Yes.
So minus 47,250. So I'll put it in bracket. Wengine wako sawa. We don't want to lose anyone. So we go to year 2. Year 2, we have our first year is still 100. Year 2, as at 31st December, our exchange rate is at 110. So this is the current price. So you have an inflation of 10 shillings. So what are you going to get? So 110 over 100 multiplied by 195.
To 14,500.
214,500. Multiply by 3 over 13.
49,500.
49,500. So that is our depreciation. So we have the net book value. So our net book value will be now is equal to this plus this. So that will be the net book value, right? And our net book value will be our gross profit, right? Is it gross or net? So our net profit, because in this case, we don't have any other depreciation. We don't have any other, I'm trying to plug in I'm losing connectivity. So I'm trying to log in using another device. Am I stable? You lost me.
No, you're okay.
Can hear you.
You're okay?
No, you're good.
Okay. So in other words, I'm saying that this is our income statement. Reason being, the only overheads or the operating expenses that we've had is depreciation. So the figures that we have here portrays our income or our profits, if we may say. So without further ado, I said I was making it simple. I want us to do the statement of financial position, or rather the balance sheet. The statement of the financial position. Something has happened and I've lost my question, so I'm trying to fetch it. I thought it was connectivity. It's like I've closed it indefinitely. But I'm getting it. But we have the value of our building on our end, isn't it? What's the on cost of the building? Are you still there? Yeah, I'm back. Yeah, so our assets, we have the assets, the value. So our building will be valued at you can see my screen. What am I sharing on the screen? We have the Excel sheet, right?
Yes.
So we have our building. I was asking what is the value of the building for year one. Just note it as Y1. We have Y2 for year two. What will be the value of our building? Which figures are we taking to the balance sheet? The adjusted or the historical? We are talking about the current purchase price, isn't it? This is CPP. So adjust the figures for year one. The same case we've adjusted the depreciation. We adjust the figure for the building. So the 100 was corresponding to 195,000. What about 105? We had gotten that figure somewhere. Who was giving that figure?
It was at 204,750.
204,750. Wonderful. For year two, it was
214,500.
214,500. Then from there, You are supposed now to get the accumulated depreciation. What was the accumulated depreciation for the first year? It is there. It is 47,250. For the second year, what is the accumulated depreciation? We add these two. It is 96,750. Don't forget about the accumulated depreciation. So what are we getting as our net book value? And to copy the formula. Then this number are not making any sense in accounting. So I can just add the commas to reflect money. So that's where we are. What can you see from the account? I want us to think on our feet. That's the net book value. Remember, you have the current assets, we have the cash. What's the figure for cash?
$45,000 for the first year.
Are you going to take 45,000?
Without adjusting that.
We are working with the current. That's why I'm saying we need to think with our feet. So we are looking at the purchasing power. At the end of the day, we'll want to know whether it's a loss or a profit that we are making. Remember, we are looking at the income. What will be our monetary assets in the start of the second year, at the beginning? That's what we need to reflect here. It will be 47,250, isn't it? 100 is equivalent to 45. So what about 105? What are you getting?
7,250.
47,250. So that's the value of cash. $47,250. So as at the end of the second year, what will be the value of cash? Remember, our current purchasing power is 110. Let's think with our feet. What will be our current purchasing power as at the end of the period? You people have taken forwards and futures, isn't it? You've taken forwards and futures, isn't it? Did you cover forwards and futures contracts in your advanced accounting one? Okay, assuming you didn't even cover, I bring back the rationale I was giving of bread. When you are starting your year, the value of cash that was in the account was 45,000. That was the cash that you had, the spot cash in the account. As at the end of the period, you've not drawn, you've not done anything. So the money is still there. Have you gained or you have lost? As at the end of the period, we have 47,250. Felix, have we gained or we have lost?
We have not gained.
When the value of the shilling to the dollar now fluctuates due to inflation, do we lose or do we gain?
We lose.
We lose.
Yes.
So we have a purchasing power loss, right? Of how much?
Yes.
Of how much as at the end of the period? It will be the 47,250. We minus our
47,250.
we less 45,000, isn't it?
50 minus 50,000.
So it's a loss. 2,200. Yeah, 2250. So I need to come back to the income statement and reflect that loss because it is a loss and it's going to reduce the value of the net income as at the end of the second year. Are we in agreement? So what has happened to our purchasing power? It has gone down, so it's a loss. So purchasing power, I wanted that to come out clearly. Loss. As at the end of the period will be 2,250. Well, it's a loss, so I was supposed to put it in the bracket. So I can now say my net income, we are now closing the books, is equals to, now for the first year, let me space my work look unkempt. So some of the disadvantages of working online, especially for the practical subjects like this one. So our net income, it will be retained. So here I'll still have the 35,250. For the second one, it will be equal to this, here this. Now, I take you back now to the statement of the financial position because we need now to adjust the figures for capital, right? We need to adjust the figures for capital. So for the second year, what is our cash? What is our cash in the account? Think with your feet. If you go to the additional information you've been told, all the net income is paid out as dividend. The balance of cash is banked at no interest return. There are no operating expenses except depreciation. and all revenue is received at the end of the year. Don't keep quiet. So what will be our cash as at the end of the second year? Remember, all the net income has been distributed as dividend. So it is not interfering with the cash in the account. So what will be the cash in the account, or the cash equivalent in the account?
I think if it's not affected, it will remain the same.
It will remain the same, but it's affected. The current purchasing power is 110 as at the end of the second year.
120, that's 51, 47,000. 51,975.
51?
975.
I say no.
Oh,
What was our money asset as at the beginning of second year? You know, we are talking about money here. Now we are not talking about the assets. This cash.
Going to be 99,000.
Yes?
It's going to be 99,000 because the cash was 90,000.
The cash was 90,000. I again say no. That's a good thinking. You are thinking in the right direction. Now just go back and look at the corresponding in our building. Look at the corresponding figures. You see, when we depreciate, we have to provide for that depreciation, isn't it? We are losing an equivalent of that cash, isn't it, guys? We are presuming our machinery has depreciated at that value. So the depreciation in itself is a loss. Well, let us think like accounting students. It is reducing our cash repository, isn't it? Isn't it? So if you look at the depreciation, in my first year, it fully ate the account that was in the coffers. Tuko pamoja mpaka hapo? Tunaelewana mpaka hapo? So as at the end of the year, I need again to avail the amount that will be equivalent to the accumulated depreciation. It has to be retained. We are providing for depreciation of this amount. And these are the generally accepted accounting principles. So as at the end of that duration, we are supposed to have 96,750, equivalent to the depreciation at the end of the year, because that will be the amount of depreciation retained to date or to 31st December of that particular year. Tuko pamoja wenzangu?
hapana.
Okay, Felix, what is your understanding of what is depreciation? Now, explain to us like 2-year-olds. What is depreciation?
Okay. Depreciation is a loss of value on something you have.
How do you measure
So,
value?
like, let's say that you have an asset worth 2,000.
Yes,
You can't in the coming month or years, you cannot sell it at 2,000 because you
exactly.
used it, and so in this case, the asset was the building, and the depreciation was on the building.
Yes.
So how is it related to cash in the bank?
Now, what is depreciation? Is a measure of value. We've lost value, isn't it? As at the start of the year, our building was costing 214,500, isn't it?
Yes.
If we were to sell that building at the end of the year 2, we are going to sell it at 117,750, isn't it?
Yes.
What is the difference?
96,750.
No, I'm asking what is the difference? What is 96,750?
Okay, that's the lost value.
Exactly. Is it now clear?
Yeah.
I'm saying we have to set aside equivalent of the accumulated depreciation, isn't it? In our retained earnings.
Okay. I got it.
You've gotten it.
Yes.
I'm not very sure the other members have gotten it. Now let me try to make these matters easier. Let me insert. Now this is the value. Let me pick this figure and put it here. I cut and put it here. That is the value of the assets as at the end of the building, isn't it? Let me just indicate here building. Building. So this will be our value of the asset. Let me just delete that so that we are able to see. Are we able to see that? So we have the net book value of the assets, and I have the depreciation. To make it look even more accounting, let me insert this here. So undo, have inserted it before, so insert. I want to take I want to cut. Now that one is better if I arrange it that way. So we have the value of the building, we have the depreciation, we have the total value of that building. Is it now a bit clear? Is it making sense? Our value for depreciation is the amount that we had to avail to ensure that our books at the current purchasing price are still at par. Now I'm even trying our way out of now arguing this out. Now, what was our capital as at the start of what was our capital? If the figure for the cash cannot assist at this level, what was the value of capital? Let me just bring it down here. What was the value of the capital as at the beginning of the first year? If you look at the question, our Our value of the capital that we had been given, assets building was 150,000. Then cash was 45. To total to 195, isn't it? Isn't it, guys?
Yes.
So that was year one. So can we have another working here? I can call it working. You've had several workings. Let me just even call it working 4. So we can say at the opening, our 100 was equivalent to 195. Isn't it? That was our working capital, right? So what about us at the end of that year? What will it give us? It will give us 204,750, isn't it?
204,750.
204,750. As at the end of the year, second year, our assets were still valued at 195. Are you seeing? 105 plus 90. Are we there? The balance sheet. Though we are adjusting the balance sheet we had been given, the figure was still 195. Because the assets, the net was 105, then our depreciation, our cash, not depreciation, our cash was amounting to 90,000, isn't it? So again, 195 is equated to 100. What about 110 as at the end of the second year? We have the figure. It is 214,500, isn't it? It won't do us any good if you keep quiet. If you are not understanding, just say you are not understanding. Fiona Gashunga. Fiona,
Yes.
are you getting these things?
Yes.
So we are good. In other words, I want to scrap my cash because it was the retained accumulated depreciation. So if I wrap my cash, sorry, I was just putting that figure there merely for presentation. My balance sheet, if you look at my balance sheet, is still balancing. I wanted to illustrate the financial position. That's why I was working backward. So our net income is, the end of the first year is 32,250. At the end of the second year, it is, as at the end of the second year, it is 39,005 shillings, 39,005 shillings. So those are the CPP accounts. In other words, we are saying that the purchasing power gains and losses arise as a result of holding non-monetary assets or liabilities during the period. We've seen, because of the cash that we had held, and it has been marginally absorbed by the depreciation for that year, we've had a purchasing power loss of 2,250. So on the converse, we can say the purchasing power gains arise because monetary items that are fixed in terms of the amounts, the shillings, will be received or paid for us to get the gains. But in our case here, we didn't have any adjustments. And I was putting it that way to be as simple as possible for you to understand. So put in your mind that monetary assets receivable as fixed amounts, either currently or in the future, we have the cash and we have all the accounts receivables. Cash, we have the account receivables, note receivables, any amount receivable. It is fixed amount and we are going to take it at the current purchasing power. So the potential for gains and losses is summarized in a manner. We have a table. I want to make it. Let me stop sharing this. Can I stop sharing? Are we good? Can I stop sharing?
Good.
Now let me go back to the notes. I'm explaining this table here. Now I'm saying this is the purchasing power gains and losses summarized depending on the state of economy. And we have only two states, either inflation or deflation. If the shilling has lost power, we are going to have inflation.
Yes.
If it has gained, we are going to have deflation. That's why we are saying here on the enterprise, on the farm, for the net monetary assets position during inflation, we get what we call a purchasing power loss. And we've seen, originally we were trading at 100 shillings. Year one, we closed at 105. Year two, at 110. We incurred a purchasing power loss. If it was deflation, for instance, if the shilling was exchanging at 95, we would have had a power gain, a purchasing power gain. For the net monetary liabilities, when it is during inflation, we get what we call purchasing power gain. During deflation, we get purchasing power loss. And if you recall, when you are doing the accounting for foreign currency transaction, there is a reason why our liabilities were being retained at the domicile territory, where the subsidiary is operating. We were doing that to avoid the purchasing power gain because we would have misrepresented the facts. Are we there, guys? Now, some of the advantages of CPP, if you cannot still get this, I normally give students just assume you are going to China next month. You go to China today, not you go to China, you go to the bank today, you want to purchase the air ticket. The value of the shilling to the dollar is 100 shillings. And you book or you purchase the ticket. If it is what we call just in time, you are supposed to fly in the evening. If you are going, let's say, to fly 1 month after now, like what happened to Corona, people had planned to travel, let's say on 15th March. All the airports globally were shut. So what happened? If you had purchased, the airline will not return your air ticket. They'll just withhold the money, awaiting until the economy opens. If the economy opened at a point where the dollar is now, we've said when you are purchasing the ticket, the dollar was exchanging at 100 shillings. Right now, because of the effects of Corona, we have inflation. Let's say right now, 110 shillings is equivalent to $1. Are you going to gain or lose if you are to travel? You are going to lose, isn't it? Because what you are holding was a liability. You are going to lose. Because you have to fetch now 10 shillings from your pocket for every dollar that you had paid ticket for you to be at par. Are we there? Now, these are the problems of CPP. One is the balance sheet treatment for non-monetary assets, and we've seen it's normally regarded as an extension of historical cost, because we've seen we are still going back to the historical cost of the non-current assets. So our resulting figure, they will have more or less the same semblance to the current values of such assets. It doesn't make a lot of sense. Now, our profit, if you look at the profit that you are reporting there, the net income, the CPP profit consists of trading profit and losses, monetary gains and losses. That is why we reflected the 2,250 with the substantial liabilities, only that in our case, we didn't have the liability, but we are coming to a more broader example. So our CPP profit is giving a misleading impression, because we are going to pay the dividends, but you can see what is happening in our accounts. All the cash that is remaining there is going to cater for depreciation. It is misleading. So in some situations, if you use CPP, you may end up declaring dividends and you have incurred a purchasing loss. Then the difficulty of understanding. Now, you can bear me witness that is not the best thing, isn't it? It's really juggling your minds, working forward and backward, to a point where Felix was asking, how are we getting these figures? Isn't it, Felix? Felix?
Yes.
So now we normally say in the gaps that your financial reporting is supposed to be simple. Simple for any other person who is interested, or for the users. Your financial reporting is supposed to be so simple such that anyone can interpret. But you can see when it comes to CPP, you must be an accounting student. Leave alone a user, you must be an accounting student first, isn't it? That's why we say this information is for analysts. It's not just for any layman outside there. This is what managers are supposed to consume. Now I want to go to the current value accounting, and in this model, we normally have we have three. We normally have three scenarios, or we have three models that we accommodate. We got what we call the economic value. We have the economic value method. We have the net realizable, the exit value, and the last one is the current replacement cost. Now we've had the economic value, so I don't need to go back. And we've indicated that under this method, our current value of individual asset is based on the present value of the future cash flows. What we normally do is try to discount them to the present, right? So discounting, we did not go back to the discounting methods. So let me look at the last two. We have the net realizable method, we have the criticism, and you can see, I think I've already explained that. Now for the net realizable method, under the NRV method, asset values in the balance sheet are based on the net price that could be obtained in the open market if you were to dispose them today. That's why we are calling it net realizable value. Actually, I've said we also call it exit value. If you are winding up, okay, assuming it's not a going concern, suppose you are to wind up today, what you can fetch from all the assets in your balance sheet, that's what we consider net realizable value. And that is the method. Now, the problem of the NRV, or the net realizable value, accounts are prepared on the basis that shows the current financial position. But we do this in anticipation of continuing to run for unseeable future. We don't do our financial statement as at the end of the period to wind up, unless now the company is dissolving. But if we are not winding up, this information is useful to the users of the financial statements. We have the managers, shareholders, bankers, etc. And they help them in making the different decisions. For the shareholders, whether to inject more capital or equity into the business. For the management, in forecasting in the future cash inflow and the cash outflows for the expense items. For the other, for example, the bank will need this information to know whether we are credit worthy, whether we can be given a credit or not. Now, the disadvantages are, now this method places now a great emphasis on liquidation. We are assuming that we are winding up, we want to close our company, which is not the case. So the method would be so costly and time consuming, involving a lot of assessment. We have to send our field officers, cost accountants, to go outside there and try to get the right value or the prevailing cost of the particular assets that we are holding in our balance sheet. It is also possible that some company assets may lack realizable market value. I can give you an example. A farmer, let's say, who is farming wheat, considers a combine harvester as a very essential equipment in their operations. If you take the same combine, the combine harvester to someone who is doing, let's say, vegetables, would it have the same value? Guys, the value of the combine harvester to the wheat farmer was so high. To the vegetable farmer, it can be parked somewhere at the backyard because they don't need it. We don't need the combine harvester when we are doing our vegetable farming. Are you getting the rationale? So if we are liquidating, the liquidation value to you may not make sense to the person outside there. Now, it may also produce very unrealistic fixed asset values. And a good example is specialized plant that has a so high value to the farm that is operating in. For example, if you go to EABL, they have sophisticated machines that does the bottling of the beer. If you bring that machine outside roasters, hapo tu nje ujaribu kuuza, who will be interested? The only person who can be interested in such a machine is Keroche Industry, but they have their own plant. Are you getting the big picture? So it could be a specialized plant that is worth billions. But when you bring it in the streets or at the marketplace, people don't see any value. So in absence of liquidation, net realizable value is meaningless. Are you seeing that? And lastly, in case of stock, profit is taken before goods are sold, which is infringing on the realization concept. We normally say we are supposed to consider revenue at the point of transaction. So you cannot value your stock, and that's why we valued them at the prevailing market value or the acquisition value, whichever is lower, to avoid infringing on the realization concept. I want to combine the two before bringing an example. Now, the replacement cost method, we call it entry value. The other one was exit value. So this can help you now make the difference. Now, this method, it requires that the value of the items be adjusted to reflect the cost at which it could have been replaced in the normal course of business, either at the date of sale of goods or at the balance sheet date. That's why we are calling it the entry value. That value that you are willing to place your goods at, either at the sales value to realize a revenue or at the balance sheet date. In other words, we are talking of the value of the farm. I want you to take into consideration, we are not looking at the liquidation. So we are placing our farm at the current status before we critique. Any question to date? I want to bring an example before we go to the other values. We have the current value accounting, a bit sophisticated than the first three, economic, the NRV, and the replacement cost method. Now let us assume the same example. You have I believe you still have your illustration. Do you? You have not closed your illustration because we are riding on that. Tuko kwa hiyo illustration niliwapea. So I'm saying illustration 2, we assume the same data for illustration 1, only that we are now replacing the building. So we are replacing the cost for a new building on the additional information. It is still Nyumba Limited, only that we are replacing now the cost for the new building at 180 in year 1 and 210 at the end of year 2. And that is the replacement cost approach. Let us start with the replacement cost or the entry value. Then it's like we'll be working now forward. We start with the entry value, we go on reverse to the exit value. Tuko hapo? Confirm that we are still together because I need to stop sharing and go back to my working Excel. Felix, Fiona, Dennis, Zuhura. Hii maneno inachanganya,
Yes, together.
najaribu kuabsorb. Let me share. Let's work together and see how it pans out. So I go back to my income statement. Allow me to, let me rub this. Should have deleted. Want to make it clean. So we are only replacing the assets, and we are in year 1. We've been told that the replacement cost for a new building of the same type is 180,000 at the end of year 1 and 210,000 at the end of year 2. So what is the value of the asset? At the end of the year, we have been told it will be 180,000. We are just replacing, isn't it? At the end of year 2, it will be 210. So I'm working with the information that we've been given. Depreciation is still on straight line, and it is still 4 and a third years. So can we get depreciation for year 1? Our own cost is 180 at the end of the year. So 180,000 divided by 4 and a third years, or multiply by 3 over 13. What do we get? I'm confusing you.
41,538.
Allow me to delete these figures first. I placed them at the wrong place. It should be here. It is the value of the building. So they are not supposed to be in the income statement. They are supposed to be there. But it's okay. Either way, it's okay. So the figure for depreciation is
41,538.
41,538. What is the revenue? The revenue stays. This is supposed to be in bracket. Nothing else is changing except the value of the assets that is being replaced. It was 82.5.
92,500.
It was 92 or 82?
92.
I don't think so. What has changed? You see, we are assuming the past data. Was it not 82.5?
Yes, it was 82,500.
You had said, where did you get 92.5? What was the revenue for year 2? In our illustration 1.
90,755.
90,755. What the depreciation for second year? What is our own cost as at the end of the second year? It is this figure, 210. So 210 divided by 4 and a third, or rather multiplied by the reciprocal of the improper fraction, 3 multiply 3 over 13. What do you get?
$48,416. Should I round off?
Yeah, it's okay.
462.
462.
Yes.
I'm supposed to use not purchasing power and supposed to get away with these figures. So whatever I get here is my income. Here in Kizungu mingi. So my net income is equals to this we'll do for the two, then we see how it pans out. So that is our net income, unless more information comes up. These are net income figures. I can double underline that. Now I go to the statement of financial position, right? So which cash am I supposed to set aside as the figure for depreciation? I'm on you. I'm asking which figures am I supposed to set aside as figures for depreciation? You already have the figure for depreciation. In our case here, it is 41 Don't keep quiet, and the time is not on our side. So what will be the NBV? You work backward. So it will be this figure plus this figure. Is it plus or minus? I should minus to get a positive. Isn't it? Am I on track? Oh, I'm getting different numbers. What is 180 minus 41, 538?
138, 462.
138, 462. Don't know what has happened to the Excel. So that is my asset, the replaced asset. Now we come to the year 2, and this is where now the quagmire is. As at the start of year 2, what will be my net book value of the asset? Or we work backward. We have the depreciation. Our depreciation here is 48,462. Is it the depreciation for second year? Is it the depreciation for second year?
I think the accumulated depreciation
Will be
the 90,000.
90,000. Wonderful. Why 90,000? Explain to us.
Is the 41,538 you had the depreciation for the second year.
So you are getting 90,000. Wonderful. Yeah. So what do we get as the book value? Just subtract.
120.
Is 120.
20,000.
Any question on what you've done? I want us to look at capital before we conclude. What will be our capital? The capital for the first year is? What is our capital for the first year?
$225,000.
In the first year. Why 225? Support your answer. There is no wrong answer in this class. We are learning. Why do you think so? Don't shy away. Now, is it Felix who has given us a figure of 90,000?
Venice.
I want to prove you wrong. My thinking was are you listening? Am I audible? You can hear me?
Yes.
Yes, can hear you.
I've said the method requires that. I'm reading the second point of the replacement cost method. The method requires that the value of items be adjusted to reflect the cost at which it could have been replaced in the normal course of business, either at the end of the sale goods or at the balance sheet date. Our balance sheet date for this year is 31st December. But Felix has brought the figures for the previous year, which locks it out. You say the method requires the value of items for this particular year to be replaced. I'm trying to avoid using your accumulated depreciation as at the end of year one. Reason being, I know the current. If I was to depreciate my building for this year, I know it will be 48,462. So for 2 years, it will be double this amount instead of 41,538. Am I making sense? That will be the current value of the farm. If I go back, I'm basing my argument on historical cost approach. I'm supposed to replace with the present. To mean my figure here is supposed to be equal to 2 years multiplied by the cumulative depreciation, which is that. So what is 210 minus 96,924? I wanted us to read it from the same page.
113,076
113
and 76.
So that way I can say that my books are not compromised. I've just replaced. And we can now argue out. Suppose I add this figure to 90,000. Add that figure, you add 90,000.
$203 and 76.
203 and 76. It is not making sense, right? Wanted to see whether we can run back and have the, it is not. Now, for them to be comparable, let us do I want to copy this and put it here on the side. What I won't change is the figures, because I want us now to look at I can call this replacement approach to see how things will pan out. And I call this the net realizable value. I want us to work on let me just delete this. As we ponder that, let us try to do the NLV, the net realizable value approach. And we've been told for the net realizable approach, we've been told the net realizable value for the building is 135,000 and 120,000 at the end of year 1 and year 2 respectively. At the end of year 1 and year 2 respectively. So we've been given the value of the building. Can put it here, 135 and 120. Can you get the depreciation? For the net realizable value is very easy. What was the on cost of the asset in illustration 1? It was 195, isn't it? So depreciation, we are just looking at the net realizable value. So this will be equal to 195 minus the value. So our depreciation is 60,000. This is equal to, our value is 195, we less the net realizable value. In other words, the cumulative depreciation for year 2 is 135 minus 120, which is 15. So we've taken 60,000, we've added 15 to get 75. Are you seeing how we are getting there? So this one doesn't have any problem. So this one we can just balance off. Si kila mtu ameelewa? Escape. I want us to come here and have more time here. So we are relying on the original data. So this is 82,500. The original data is 9755. So what I need to get from you is the depreciation that you've done in number 2. So I just put it in bracket, it's 60,000. And the depreciation for this was 15,000. So the accumulated depreciation was 75. So our net income, this less this, our net income is That is the current situation. Did I less or I'm adding? I'm not doing the right thing. So this should be this plus, not minus, to get the, should be adding, not minus. How do they compare? You see, for net realizable value is very easy. You just need to get the figure of depreciation, you net off. Don't keep quiet. So if you look at the net income that we are reporting, the reason why we are saying that will be misleading the users of the accounts, you can see we are getting different figures. What did we get for the economic value approach? What did we get for the economic value approach? Remind me the figure so that we compare the three. The first one, what did we get? Felix, do you have the figure somewhere?
For the CPP,
Yes.
the CPP, the net income for year one was 35 to 50.
35 to 50.
And then 39,005.
39,005. So we have the three figures. For CPP, we got 35 to 50, 39,005. So you can see the figures that are being reported by the net realizable value. And we can see the figures that we are reporting for replacement approach. And that's why the approaches have always been an elephant in the room. Scholars, the academicians have never agreed on which is the best method to use. And when we get all these arguments, we revert to historical cost approach. Because whatever the figures that we get from the historical cost approach, they are more or less, although they don't give us the current or the prevailing market rate, they are more or less reasonable. What are your thoughts? And we haven't had it because we have other methods that we are coming to that will even hold more gains and losses. Any question? If there are no views, any questions? Have we appreciated the methods? Do we need some more times to soak, to absorb this information? I'll attach the notes and the Do you get the videos from the ZDS content? You get the videos for the class? Do you?